Leonardo DRS just delivered an across-the-board earnings beat for Q2, and honestly, it is forcing the market to completely reevaluate its forward models today.
Oh, absolutely. The stock is catching an aggressive bid, and for good reason.
Yeah, totally. So let's just hit the numbers cold. Revenue came in at $913 million, which is a really solid 10% year-over-year increase. But, I mean, the real shocker is the bottom line.
Right, the EPS.
Exactly. Adjusted diluted EPS hit 0.35 cents. That is a massive 52% increase year over year. And management didn't just sit on that momentum. They actually went ahead and raised full year 2026 guidance right away.
Which is always a huge signal of confidence.
For sure. So adjusted EBITDA is now projected between $525 million and $540 million. And they bumped the adjusted diluted EPS target up to a range of $1.34 to $1.39.
And you know, for retail investors tracking the defense sector, the sheer magnitude of these numbers is just, well, it's wild. But the mission for this deep dive is to unpack the underlying mystery here.
Right, the margin disparity.
Exactly. How do they generate 33% adjusted EBITDA growth on just 10% revenue growth? Because in the defense sector, which is, notorious for these tightly contested, heavily audited contract margins, that kind of expansion is highly unusual.
Yeah, you just don't see it.
You really don't. And we also need to look at their record $5.1 billion backlog. For anyone allocating capital in this space, a backlog that size isn't just like a list of future orders. It's a complex indicator of exactly where the Department of Defense is directing its cash in a very volatile geopolitical environment.
So basically, they are squeezing significantly more profit out of every single dollar that comes through the door.
Yeah, a lot more.
I mean, the adjusted EBITDA margin expanded by a full 240 basis points, bringing it up to 14.0% for the quarter. In legacy manufacturing, adding nearly 2.5 cents of pure operating profit to every dollar of revenue in a single year, that's a massive structural shift.
It's huge. And management attributed this to what they basically called a trinity of financial metrics, right? So disciplined program execution, a favorable mix, and increased volume leverage.
Okay, I really want to break down that last one, the volume leverage, because it's the mechanical engine behind that 33% profit jump.
Go for it.
Think of a defense contractor's operations like a massive, automotive factory. If you run that manufacturing plant for a standard single shift, you are entirely on the hook for the baseline fixed costs.
Right, the facility lease, electricity, all of that.
Exactly. The security overhead, administrative salaries, all of that is fully baked into the cost of that first shift.
And we should point out, in defense contracting, those fixed overhead costs are exceptionally high. Just the security and compliance infrastructure required just to, keep the lights on is staggering.
Which is exactly what makes the second shift so lucrative.
Yeah.
If demand spikes and you have to spin up an extra shift, those fixed overhead costs are already paid for by the first shift.
Right, they're covered.
You are now only covering the variable costs, like the direct labor and the raw materials for the new units. Because the heavy lifting on overhead is done, the revenue from that extra shift flows almost entirely as pure profit, straight to the bottom line.
And there it is. That is volume leverage in action.
Right. And it totally explains why a 10% bump in top-line revenue can trigger a 33% explosion in EBITDA.
It does, but it also highlights the danger of falling revenues in this sector because volume leverage works in reverse just as violently.
Oh, for sure.
But obviously, for this quarter, the volume was clearly there, and they actually supplemented that operational leverage with some below-the-line financial engineering.
The interest and taxes.
Exactly. Lower net interest expense and a lower effective tax rate acted as like an additional tailwind.
Yeah.
That's what ultimately pushed that adjusted net earnings figure up 52% to $94 million.
Okay, so I buy the volume leverage argument all day, but I really have to push back on management citing a quote-unquote favorable mix.
Really?
Because as an investor, whenever I hear a company claim that a favorable mix drove margins, I immediately wonder if it's actually sustainable. Like, did they structurally improve their product portfolio? Or was this just, a lucky quarter where a disproportionate amount of high-margin contracts just happened to hit the billing cycle at the exact same time?
That's a fair question.
Right, because if it's just a lucky billing cycle, those 240 basis points of margin expansion could just vanish by Q3.
It is a valid skepticism, definitely. But if you look at the underlying segment data, it really suggests this is a structural evolution, not just some timing anomaly.
Okay, tell me why.
Just look at where the revenue growth actually materialized. It was led by highly complex mission-critical systems. We're talking tactical radars, electric power and propulsion, infrared sensing, force protection.
So not just basic commodity parts.
Exactly. These are not commoditized off-the-shelf components where you're just fighting for pennies on the margin. These are deeply integrated technology platforms.
Right.
When a company executes well on these advanced programs, the margins naturally expand because the DoD is paying for specialized intellectual property and proprietary engineering capability.
Oh, okay. That makes sense.
So it's less about a random assortment of good contracts hitting the ledger and more about, consistent systemic demand across their higher margin differentiated portfolio.
Yeah, and actually, the cash flow metrics seem to completely support that structural argument. They reported free cash flow improving to $6 million.
Which doesn't sound like much at first.
No, it doesn't. At first glance, $6 million in free cash flow on $913 million in revenue sounds, well, not particularly impressive. But you have to look at the context of working capital efficiency here.
Right.
They generated $35 million in net cash from operating activities, and then they turned around and poured $29 million back into capital expenditures.
To come out free cash positive while actively ramping up capital investments is a really strong signal.
Exactly. And management is now targeting approximately 75% free cash flow conversion of adjusted net earnings for the full year.
That 75% conversion target, that is the metric retail investors, should literally be circling in red ink right now.
Because of how capital intensive the sector is.
Precisely. Defense contractors are notorious for locking up massive amounts of capital in inventory and receivables. I mean, the government pays when the government wants to pay. And building complex hardware requires massive upfront cash outlays for materials.
Right, you're buying all this steel and tech months before you see a check.
Exactly. So for DRS to demonstrate this kind of quarterly linearity converting operational success into actual liquid cash, it proves they're aggressively managing their working capital. They aren't just booking paper profits, they are building a real cash-generative machine.
I love that. Okay, so that cash flow is a great snapshot of the present. But as you know, defense stocks trade on multi-year visibility, not trailing quarters.
Absolutely.
If we want to actually sustain this raised 2026 guidance, we have to look at the pipeline. And the leading indicators in this Q2 report might actually be even more aggressive than the trailing margins.
The bookings were wild.
Right. Bookings for the quarter hit $1.1 billion. That translates to a 1.2x book-to-bill ratio.
Which essentially means for every dollar of revenue they actually recognized and billed this quarter, they added $1.20 in new funded orders to the pipeline.
It's just a compounding growth engine at that point.
Yeah, and it's not some isolated one-off contract spike either. They have maintained a consecutive quarterly trend of demand sitting at or above 1.0x.
And that sustained influx of orders is exactly what elevated their funded backlog to a company record of $5.1 billion. That's a 17% increase year over year.
We should probably emphasize the distinction between a funded and unfunded backlog here because it's critical for retail model.
Yeah, good point. Break that down.
So a $5.1 billion funded backlog means the government has already appropriated the capital, the money is there, it gives management concrete, multi-year visibility, which honestly is the primary reason they felt confident enough to raise the full-year outlook. It completely de-risks the immediate future.
Okay, but they aren't just relying on organic pipeline growth.
Right.
The report also detailed a massive inorganic growth catalyst. They announced a $450 million acquisition of a company called Raft.
Yeah, this is a big pivot.
The stated objective is to expand their multi-domain AI, data fusion, and mission software capabilities. But I'm going to throw a massive red flag on this play right now.
Oh, really?
Yeah. Look, Leonardo DRS is, at its core, a legacy defense hardware manufacturer. They bend metal, they build advanced physical sensors, heavy electric power systems, physical force protection.
Right.
Dropping nearly $500 million on an AI software company, it just feels like they're chasing the shiny object of the moment. Does this acquisition just dilute their core competency? Or are they just desperately trying to buy a higher software multiple in a hardware sector?
I get why it looks like that. It's very easy to view it as a buzzword acquisition, right? Like, oh, they bought an AI company. But if you actually look at the reality of modern defense procurement, it is an absolute survival pivot.
A survival pivot. That's a strong phrase.
I stand by it. The days of the DRD buying, dumb hardware are totally over. The modern battlefield is defined by autonomous, dynamic, interconnected systems.
Okay.
Like a tactical radar is completely useless if it can't instantaneously share fused data with an air defense battery that's miles away.
Right, the network is the weapon.
Exactly. So by acquiring Raft, DRS is acknowledging a really hard truth. Their physical hardware is only as valuable as the AI and data software powering it. So they aren't diluting their identity at all. They're protecting their existing hardware revenue streams. They have to ensure those platforms can actually integrate into the DoD's next generation digital architecture.
Okay, strategically that makes sense. But just from a balance sheet perspective, $500 million is a massive capital outlay.
It is, but look at how they're funding it.
True. They ended the quarter with $270 million in cash and literally zero outstanding borrowings under their credit facility. They basically have a completely unlevered balance sheet.
Which means they are executing this pivot from a position of profound financial strength. They are not over-leveraging themselves just to chase the AI trend.
Yeah, and they even simultaneously declared a cash dividend of 9 cents a share, plus they repurchased about $12 million worth of common stock during the quarter.
Exactly. Returning capital to shareholders while funding a $450 million acquisition out of existing liquidity, that is just a massive flex of balance sheet flexibility.
Total flex. But to understand exactly how they generated that liquidity and where this massive $5.1 billion backlog is actually being deployed, we have to tear down the two main operating segments, Advanced Sensing and Computing, or ASC and Integrated Mission Systems, which is IMS.
The divergence in performance between these two segments is definitely the most fascinating part of the operational data.
So ASC is the larger of the two engines, right? Revenue for ASC came in at $587 million, which is an 8% increase year over year. Management cited tactical radars, infrared sensing, and naval network computing as the primary drivers there.
Right. And ASC's segment adjusted EBITDA margin rose 110 basis points to 11.8%. Operating earnings for the segment hit $49 million, which is up 32%.
And their bookings remained incredibly healthy at $691 million, keeping that segment's book-to-bill locked at 1.2x. So ASC is essentially functioning as the steady, reliable baseload generator for the whole company.
It's the anchor, without a doubt. But the IMS segment, that is functioning as the high-octane turbocharger.
Yeah, this is where the numbers just stop making sense in a traditional hardware context.
Right. So IMS revenue reached $333 million, a 15% increase, driven almost entirely by heavy electric power and propulsion programs.
And the margin didn't just expand, it completely exploded. IMS segment adjusted EBITDA margin jumped by an astonishing 460 basis points, landing at 17.7%.
Just unheard of.
Operating earnings for the segment jumped 61% to $53 million. I mean, look at the absolute dollars here. ASC is the much larger segment, generating $587 million in top-line revenue.
Yep.
Yet the IMS segment, on just $333 million in revenue, actually produced more pure operating earnings, $53 million versus ASC's $49 million.
It's crazy.
My theory is that IMS is quietly transitioning from a secondary operating unit into the primary profitability engine for the entire enterprise.
Oh, the math fully supports that theory. A 460 basis point margin expansion in a single year for heavy physical manufacturing. That is almost impossible without a fundamental change in the underlying business model.
So what's driving it?
What we are seeing in IMS is the absolute extreme of that volume leverage concept we discussed earlier. Electric power and propulsion systems, like the ones they build for naval platforms, are incredibly complex, extremely labor-intensive builds.
So huge upfront costs.
Astronomical upfront fixed costs for engineering, tooling, and testing. But once those designs are locked in and the production line reaches scale, the marginal cost to produce the next unit just plummets.
So IMS isn't just growing revenue, it's hitting the exponential phase of the manufacturing profitability curve.
Exactly.
Okay, so we have record backlogs, an unlevered balance sheet, and a segment expanding margins by 460 basis points.
Yeah.
I mean, it is very easy to just extrapolate this bullish narrative infinitely into the future.
You have to be careful with that.
Right, which is why we need to look at management's broader macroeconomic view. And more importantly, the specific landmines buried in their risk disclosures that could instantly derail this whole thing.
Yeah, on the macro side, CEO John Bellany was definitively optimistic about the broader defense investment environment. He mapped out their positioning against the DoD's highest priority investment vectors.
Air defense, counter-UAS?
Right, which is counter-unmanned aerial systems, basically drone defense, plus space, missiles, and naval platforms. The secular tailwinds for defense spending are just undeniable right now.
But the forward-looking statement section reads like an absolute horror story for supply chain managers.
It really does.
They explicitly call out sustained inflation, severe cost pressures on labor, and the specific threat of electronics and component shortages. As a retail investor, it is incredibly dangerous to look at a $5.1 billion backlog and just view it as guaranteed cash.
Because it's not. That backlog is highly concentrated in U.S. government contracts, which come with a very unique set of vulnerabilities.
Explain that for the listener.
Well, these contracts are frequently only partially funded upfront, which means they are subject to immediate termination for convenience by the government.
Or they can just be frozen entirely by congressional gridlock. Like a prolonged government shutdown or a failure to pass a defense appropriations bill means DRS still has to carry the overhead of those manufacturing plants, but the revenue spigot gets turned off literally overnight.
It's a huge risk.
But the specific risk factor I want to hone in on is their exposure to fixed-price contracts. If you want to understand how a beautiful backlog turns into a toxic liability, you have to understand fixed-price contracting.
Oh, this is the trap.
Right. It's essentially like locking in a massive, elaborate catering gig for a wedding 3 years in advance. You agreed today to cater the event for a set price of, let's say, $50,000.
Okay.
But what happens if, over the next 3 years, inflation goes rampant? The cost of beef triples, the cost of labor doubles, and the cost of transport skyrockets.
The client, in this case, the Department of Defense, they don't care. They are paying the agreed-upon $50,000, period.
Exactly. The caterer has to absorb every single cent of that inflationary cost overrun directly out of their own profit margins. For DRS, any deterioration in their ability to accurately forecast raw material costs over a multi-year horizon or any failure to manage their supply chain logistics means they eat those losses.
And that cuts directly into that beautiful 14.0% EBITDA margin.
Precisely. When inflation is tame and execution is flawless, fixed-price contracts offer excellent margins because you get to keep all the savings from your own efficiencies.
Right.
But the moment the macro environment turns inflationary, those exact same contracts become severe structural vulnerabilities. It's the ultimate double-edged sword of defense investing.
Which is why we really have to view their current obsession with operational efficiency and working capital management through a totally different lens. Well, hitting a 75% free cash flow conversion rate isn't just about juicing the metrics for Wall Street. It is a defensive necessity. They have to insulate themselves against the inherent risks of fixed price exposure in a volatile supply chain environment.
That makes total sense. So let's distill the core of what we've unpacked for you today. Leonardo DRS delivered a Q2 that absolutely forces a reset of expectations.
Completely.
They posted double-digit top-line growth, but managed to leverage that into a massive 240 basis point expansion in EBITDA margin. They fortified their multi-year visibility with a record $5.1 billion funded backlog, and they're leveraging an unlevered balance sheet to make a $450 million strategic pivot into multi-domain AI via the Raft acquisition.
And remember, the underlying fundamentals are operating at peak efficiency, specifically within that integrated mission systems segment. IMS is proving to be a high-octane profit engine capable of staggering margin expansion as volume scales.
Absolutely. But as you adjust your models and track this stock moving forward, I want to leave you with one critical variable to monitor, and this won't show up on a quarterly balance sheet.
Okay, what is it?
As the defense sector continues to pivot from traditional kinetic hardware to data-driven, AI-powered systems, we are going to see massive M&A crossovers. Leonardo DRS just paid $500 million for a software company.
Right.
Legacy defense manufacturing cultures are famously rigid, process-heavy, and risk-averse. Software engineering cultures are agile, iterative, and they move fast. How will DRS integrate Raft without those corporate cultures violently clashing?
That's the million-dollar question.
Because if the heavy metal manufacturing culture crushes the agile software culture, they will destroy the very innovation they just paid $450 million to acquire.
Yeah, integrating the technology is usually the easy part. Integrating the human capital is where these multi-million-dollar synergies often just evaporate.
You nailed it. So keep an eye on how that integration plays out over the next few quarters. And make sure you hit follow on the show for your daily no-nonsense earnings coverage.